Today's Animal Spirits is brought to you by our friends at YCharts. It's that time of year, Michael. Advisors are gearing up for end-of-the-year tax loss harvesting opportunities.
I'll tell you what time it is.
What's that?
It's heat in the house time. We'll get to that on the show. Continue.
Okay. But YCharts says clients don't want to be informed of what steps they'll take to get them to their financial goals at the year end, right? That's where YCharts steps in. They just released a comprehensive guide to saving advisors time and having more impactful client conversations surrounding tax efficiency investing, which makes sense, right? We've mentioned this before, but I think you could save someone $1,000 in their taxes or make them $100,000 in their portfolio, and they would prefer the $1,000 in taxes. People hate paying taxes.
Well, I would disagree with that.
I'm just saying.
I don't think it's quite that skewed.
I'm just saying that the response is bigger for tax savings than it is for
people. Well, people would certainly rather save an equivalent amount in taxes than make in investing. That's for sure.
All right, I'm just saying. Tax people back me up here. They always say that if you save someone money on taxes or find a mistake, like that's a client for life, right? So with YCharts, you'll be able to optimize your strategy search, speed up your workflows, and more importantly, effectively communicate tax saving strategies to clients, right? That's pretty good. So YCharts has this free guide on easier tax-efficient investing. Click on it in the link. And remember, as always, 20% off when you sign up with YCharts for the first time with code ANIMALSPIRITS. Tell them we sent you. Link in the show notes.
Welcome to Animal Spirits with Michael and Ben. I just want to brace the listeners. This is the doc is beefy today.
You showed up. You showed up this week,
dude.
Sorry, it was two times. That's it that you didn't show up.
Was I a literal no-show?
No. I remember the 1 week we were.
I do remember 1 week you busted my chops.
No, I'm just saying you brought it this week, I guess.
I brought the heat and then some. All right. So anyway, this might be a long show. I wonder what the average length of the doc is. 36 pages.
It's 30 to 40 range at least.
Okay. Well, today it's 43. I want to give a reminder to listeners and viewers, I guess, in the Charlotte area that we are going to be there. I'm going straight from Vegas from the Giants game, 2-5. Could be 3-5 after the Jets. Could be 4-5 after the Raiders. We'll see. By the way, I have some football takes. So I'm going straight from Vegas to Charlotte. We're going to be there from November 6th to November 8th. Of course, we're doing the live Compound and Friends, which is sold out. But if you're in the Charlotte area, whether you're a prospective client or an advisor that wants to talk to us, we've got the whole team coming or a lot of the team coming. And if you're an advisor outside of Charlotte that wants to talk to us,
those are fun. I'm not making this one, but those are fun trips because we talk to advisors, we talk to prospective clients, we talk to current clients. It's a fun deal, and there's a bunch of people there.
I wrote a quick post yesterday plugging the trip, and I mentioned that we do a lot of content, obviously, and it helps our advisors start the conversation on second base. Everyone listening probably knows my background where I was cold calling, offering shitty products to people that definitely didn't want to talk to me, hence the $256 in 2010. But I say that to say that nobody's ever read a blog post, even when Ben's phenomenal blog post, to be like, take my money. That is it. Wow, what a blog post. We have to demonstrate competence, expertise, empathy, listening, solution-based answers and all that sort of stuff. And our advisors do that in spades.
If someone did say, take all my money because I like your content, that'd
easy come, easy go. Easy come, easy go. Exactly.
Yeah.
Okay. And then I'm also going to plug a new email address. animalspirits@thecompoundnews.com. I almost got it wrong. Animalspirits@thecompoundnews.com. Most people follow the rules, follow the new link. So I appreciate that. We still had some stragglers in the old inbox. We're monitoring both, but I'm saying with peace and love. At some point in time, we will stop monitoring.
It's a huge change. I've probably had the same email since I was a freshman in high school, and I hate my email address. It's like a Yahoo one.
All right. So Ben, I think this is a great look into human behavior, which we spoke about in the open.
It's inertia.
No, people hate change.
Yes.
And so if people are getting upset, not that they are, except for Nicole, about the new change to our email address, imagine how pissed off they get when they see gas prices fluctuating every single day and interest rates and prices. I think that's a huge part of it.
I was going to mention this on the inflation category. I paid $308 last weekend for gas.
Super low, huh?
I'm the one who always says there's a conspiracy when oil prices go up, gas prices go up faster, and oil prices go down, they go down slower. This time, did you see that? The thumbs up thing.
Was that Duncan?
It did it. No, I don't know. It did it again.
Wait, what thumbs up?
You missed this. It must have been on Ask the Compound. Like, I did a thumbs up for some reason, and then there's a thumbs up emoji that pops up on Riverside. It just did it.
Wow. Is that AI?
Yeah.
Is that generative?
It's weird.
Okay. Ben, before we get to the real show, see, I told this to be long. We're already going 8 minutes here. How long are we to be doing this for? And when I say this, like, how long are we going to be podcasting for?
Are you asking me out of your own, from you, or did someone ask this to us?
No, I'm just thinking. I've been doing a lot of introspection lately as I enter my middle-aged years. I've been thinking a lot about life.
When I first started my blog, like 10 years ago, I assumed I would make it like 6 months maybe, and I would run out of things to say. And then the writing process became part of my like learning and getting my jumbled thoughts out, and I just enjoyed the process, so I kept it going. And I never thought I'd be writing a blog. I thought, because there's a lot of people that were blogging back in the day that you and I know that like had great blogs, and they just kind of stopped. And you're like, oh yeah, that person used to have a blog, and I used to like that, and they just kind of fizzle out.
Yeah.
But it's become such part of my process that I enjoy doing it, and it's helpful for me personally. And I think podcasting is the same way. That it's a really good way to take all these jumbled thoughts in your brain and try to put them out there. And I think it's very helpful. And we have like a great audience that provides great feedback. It's a great learning action. It forces us to keep learning and paying attention.
So I didn't ask you if you enjoy podcasting, because I like it too. So
my roundabout way is like, I don't see any reason to stop. Are you ready to retire and call it quits? What's going on here?
No, I mean, no, I love every minute of this. I feel very blessed to be able to do this. I don't know. There's not a leading question, but I'm just literally, we could be doing this in 15 years. I mean, I'm pretty sure we'll be doing this in 5 years, probably 10 years, 20.
Possible. Ask me again when I'm 50 in 8 years, 9 years. I can't remember how old I am. Sure. I think we got some time left in us though.
I'm not going anywhere. I'm not going anywhere. Just think about it.
We're just hitting our stride.
All right, Ben, I feel like, higher for longer is sort of the consensus, and I feel like that happened over the last week. We're going to talk a lot about the quarter app today, which
said that last week. Yes. Sometimes I feel like you don't listen.
No, listen. Sometimes I subliminally steal your takes.
This is gonna be the end of us. You're gonna steal one too many takes from me, and I'm gonna get up and I'm gonna slam my monitor, and I'm gonna walk out, and you're never gonna hear from me again.
Well, guess what? Credit to you. You've got great takes.
Last week you go. Did we already have a soft landing? And I said yes. I said that 4 weeks ago.
Well, I guess I'm just sitting on your shoulders.
No,
that's
I'm marinated. I'm incepting these takes into your brain, and you're taking them to the next level.
Speaking of Inception, and Christopher Nolan, I rewatched The Prestige last night.
I did that a couple months ago.
Holy moly.
That's a great movie, right?
Great movie. 2006, saw it in theaters. Okay, so the quarter app, which is firing on every and all cylinder. It's incredible the progress that they're making. We're going to talk about quarter later, and of course, we've mentioned before that we're an investor, full disclosure. But they have this search tool. And so I put in the term higher for longer, and it searches all transcripts. And then it also will show you like where it was said in each transcript. It's really magical. And look at this increase in higher for longer. Now, it makes sense because rates have been higher for a little bit of time. But I feel like last week, after you apparently incepted it into the world's ethos is not the right word there, brains, that it became consensus. But then, so do you agree with that part? Do you agree with what you said, that higher for longer is becoming consensus?
Yes, and I feel like these sort of narrative things can stick, and this chart is pretty cool, yeah.
But now on the other hand, the fund manager survey that Bank of America takes, they show the percentage of respondents expecting lower long-term rates over the next 12 months. And that number is 56%, which is higher than it's been at any point by a long margin since 2003. So I can't really make the claim that consensus is higher for longer when 56% of fund managers are expecting yields to go lower. Or is there okay, companies might expect higher for longer, but investors expect rates to come down? Or is this hey, all that, there is no consensus. You guys are making shit up. Anytime people say anything's consensus, it's just, you say that to make your position feel better, about whatever your view is, right?
I think this is the macro tourist.
No, that's consensus. What are you talking about? That's consensus.
How about this? If you have macro in your Twitter handle, this is the consensus for those people. I think it's consensus for anyone who is a macro person. That's
a great point. There's groups. Groups have consensus. And then I don't know if that filters up to the whole, but
here's the other thing though. Well, just like with transitory, we never really defined it, or we never defined soft landing. It's hard to define. How do you define higher for longer? Above 4%
you know when you see it.
3 years? Like that's the thing. Like if people in the 1980s looked at us and we said rates are going to be higher for longer, they'd say, wait, you think 5% is high? Yeah. So how do you define higher? Higher than it was 3 years ago? Yes. But I would say if it stays at 5% or higher for more than 2 years, that'd be higher for longer for me. And I don't.
What about 4.5%? What about 4.5%? Is that
4.25%? That's my cutoff. I don't know. All right, the S&P 500 up 10 or 11% this year. As of this morning, we're recording this on Tuesday morning. I've asked you this before, but we're right in the middle. And this is totally rate dependent, I would say, but more likely to finish the year up 20% total or flat?
Up 20.
Possible. So you're seeing a rally. The crazy, I looked at this yesterday. The 10-year started the year at 3.9%. It went all the way to 5%, and the S&P is up 11%. I know it was up 20 at one point and it came in.
I know, but you really have to do the equal weight for this year. You really do.
Okay, here's a question for you. I looked at this yesterday because I posted this and someone replied, well, it's 7 stocks.
Right.
What percentage, I looked this up on YCharts. What percentage of companies in the S&P 500 are positive on the year, and what percentage are up 10% or more this year in the S&P?
Okay, so what percentage are positive on the year?
Yes.
I'd say it's close to 50%.
It's half, yep.
Okay, so 50%.
Percentage of S&P companies up 10% or more this year?
20%?
33%. 1/3 of companies are up 10% or more. Yeah. So that's not the majority, but that's not.
Stocks are doing.
There's other stocks that are doing okay.
Large cap stocks are doing fine. Obviously, there's winners and losers.
All right, I have a question.
Wait, hold on. Do you have any? Do you want to weigh in? More likely to be flat or up 20, or is that the Grand Rapids hedge? You're just going to ask a question, not even answer it.
I was just going to ask and not answer.
Okay,
I still say 20. I mean, if we're looking historical probabilities, 20 is more probable if that's how you calculate probabilities. Like 20% happens more often than flat. How about 15? Is that good? I don't know.
What?
So the Wall Street Journal had another 60-40 one. The trusted 60-40 investing strategy just had its worst year in generations, and they're talking about how it's the correlations are higher. You can see this. The correlation returns for S&P and Treasury bond, long-term Treasury bonds are at a 2-decade high. Why do you think that there's always so much emphasis put on the 60-40 portfolio and people trying to pour dirt on the grave? And what is it about the 60-40 that the media loves latching onto so much?
It's the benchmark, right? Like most of their readers have something similar to a 60-40 portfolio. What else were they writing about? The 2080?
It's just so here's one. Over their 50 years of marriage, Dave and Kathy adopted a time-honored Wall Street strategy to safeguard and grow their retirement nest egg, a mix of 60% U.S. stocks and 40% bonds. Now it is failing them. There have been some days more recently where I've looked at my portfolio and gone, oh crap, Dave said. Though they added even more bonds to protect against losing their principals as they age, their holdings are still down 14% from the late 2020 highs. Higher rates are hurting prices of both bonds and stocks these days.
Yeah, that 10% annual return of the last decade for 60-40.
I put this in here. The Vanguard Balanced Portfolio over the 10 years through 2021
What's it up?
was up 11% per year. I'm sorry.
The best 10-year performance like ever?
You don't get 11% per year without having a year where you're down 15 or 20%. That's the trade-off.
Yeah.
Sorry. I'm not going to cry. I'm not going to shed any tears for people who lost some money in a 60-40 after just experiencing a decade plus worth of amazing returns in that strategy.
Yeah.
Right. Here's another one though. Like the correlation thing to me, saying that bonds and stocks are more highly correlated. look at this chart. I can't remember if I put this in here before or not, but I looked at the percentage of years stocks and bonds rise together, and I did it by decade and then by total. Over the last 100 years or so, the stock market and the bond market, and this is, I use 5-year treasuries in the S&P, 2/3 of the time they rise together, because guess what? Most of the time bonds are rising. Remember, the number about the fact that they have strong correlation sometimes that's a good thing. You want that. You don't want negative correlation all the time. Like, you don't want something to go up and something to go down. That's not the way you want your portfolio. Most of the time you want them going up together.
Yeah.
Right? And I get it, the fact that bonds didn't protect last year, but I don't know. Sometimes they should be highly correlated.
I also think risk-adjusted returns are, this might be kicking a hornet's nest. Not bullshit, because I think I think risk-adjusted returns can be a good way to try to measure manager skill.
I've always been anti-risk adjusted returns.
Okay, so no. But my point is, like, let's just say you're a large cap growth manager, and you're like, well, I beat the S&P 500 for the last 10 years, right? And it's like, well, okay, but large cap growth, the category beat the S&P 500. Compare me to your category, okay? And it's like, well, I beat large cap growth by 150 basis points a year for the last 10 years. Okay, great. But is that because you owned NVIDIA and the highest beta names? So, like, for people that are doing that, it's like, no. It's not just NVIDIA. Like, look at my risk-adjusted return. I'm not necessarily taking more risk, and I've still beat the benchmark. That part of risk-adjusted returns to me is not completely useless. I understand it from that point of view. But from the point of view of selling risk-adjusted returns to an individual investor, I don't even forget about you can't even risk-adjusted returns, which is obviously accurate. It's not as if people are looking at their returns every single day. Right. So you could be like, well, this portfolio had, 10% better risk-adjusted returns, and so therefore it's a smoother ride. But is it really like, first of all, people shouldn't be looking at their portfolio every day. But let's say that the S&P, the whatever you're comparing yourself to was down 40 basis points, and like you're down like 32. Does that small, tiny risk-adjusted return incremental increase, does that compound and make you feel better over time?
Right. And people only tend to look when things are going really, really well or really, really bad. Right? Most of the time, you don't look or you shouldn't look.
Yeah, so I'm not saying it's completely useless and nonsensical, but I feel like it's probably given too much credence, more credence than it deserves.
They also had the old quote from Bogle saying, I spend half my time, he had a 50-50 portfolio. He said, I spend half my time wondering why I have so much in stocks and half my time wondering why I have so little. Which
it's a great quote.
I love it.
Now you can say that over the last 18 months, everything that I thought that I knew about the way the 60-40 portfolio broke down. That's a fair statement.
Yes.
Right? The fact that rising interest rates killed bonds and then also were the same thing that killed stocks, you can say, shit, I didn't think that was going to happen. Right? It did happen. But to now say, well, now over the last 3 years, correlations are positive, so it's actually a bad thing. It's like, come on. We're finally at a point where the 60-40 portfolio makes more sense today than it did 15 years ago. Now, of course, 15 years ago, you could have never known that the S&P would do 14% a year, and it's definitely not going to do that again this year. But at least you're not fully reliant on the S&P to deliver decent returns, which is wonderful.
One of the things I've been saying for the past 5 years or so as rates came down and kept getting to generationally low levels is you probably have to be more thoughtful about your fixed income allocation. In some mix, it can't just be as simple as I'm going to do whatever and my fixed income returns will be fine. I think you have to be a little more thoughtful about it and have a little more mixture in that bucket. All right, Annie Lowry wrote a piece of the Atlantic called The Annoyance Economy, and she's getting to the vibes thing that we've talked about a lot here. But her thing is she went through everything, inflation and rates and all these things we've been talking about, but she's pinning a little blame on the media. So she says, when I looked at the top homepage one recent Friday of different news sites, I saw 3 headlines about employment numbers. U.S. job growth surges past expectations and troubling news for the Fed. The jobs report may hamper the Federal Reserve's efforts to cool the economy and wrangle inflation, and interest rates are jumping on Wall Street. What will they do to the housing and the economy? Meanwhile, at the Wall Street Journal, markets are jittery. Here's why the strong jobs report may not help. And she said each of these stories was a good story with a lot of nuance, but the overall message was this is bad, not wow, what a labor market. And I do think a lot of it is like recency bias and that sort of thing, but we got a comment on YouTube last week saying, why aren't you guys ever bearish? Which I don't really agree with.
Excuse me?
Yeah, and you get paper bearish like
I feel like I'm
once a
always,
month.
I'm like mentally always, I mean, I don't project bearishness because I invest like an optimist, but I definitely worry like a pessimist.
I always lean glasses half full, and I've said that before. I have a positive outlook, and I think that that's like the right way to. We talk about this. The stock market is up 3 out of every 4 years on average. The economy is expanding 85% of the time. 15% of the time, it's in a recession. So I think that's like the right posture to have if you're going to have one. But I also think like my whole ethos of investing is the stock market usually goes up, but sometimes it goes down. And I don't think it's helpful for the people that are just literally bearish all the time. You see the cartoon I put in here about it's my favorite financial media cartoon about the guy screaming we're all going to die.
It's great.
And I'm not saying that this is like the media's fault either, because we know a lot of financial reporters who do wonderful work, right? I think it's a lot of times the people who wade into like finance takes who aren't in finance that do it. But I just think that there's so much doom and gloom and bearishness always and forever now, especially since 2008 and the pandemic, that what we try to do is refute it and use data and clear thinking. And if there's bad news, we're going to talk about it, but we're not going to say sell everything and
we're not going to scare
build
you.
your bunker. And yes, we're not going to use scare tactics. And I'm never going to do that.
I definitely get bearish, but I feel like I take the responsibility to the listeners seriously. And it would be very, very, very easy to frighten people and grow a bigger audience. We have no interest in that. We have no interest in that.
And that is how you build an audience these days, unfortunately, is you use negativity and scare tactics to get people to agree with you.
And we're definitely not like wildly, irresponsibly bullish. Like that's not our thing either.
We've been talking about a recession for 18 months here.
Yeah,
like
come on.
Will they, won't they kind of thing.
So I think that at the heart of this, like what the is going on with the disconnect between the hard data and the soft data? I think there's a lot going on. I was actually thinking about this at the Giants game of the weekend, which I'll get back to in a second. But I think social media is at the center of this in so many different ways. Number one, it is just virality. It's all about going viral. And the way you go viral is to dunk on other people, to make other people look bad. Look what an idiot that group is, making us feel smarter. And then, so it's social media doing that. And then it's the media competing with social media, right? Yes. The media wants your attention the media wants your eyeballs. And so the way that they do that to compete with social media is write more and more ridiculous headlines where the truth will be buried in the 9th paragraph. For example, there was an article, and we're going to talk about this, about like 60-day delinquency for subprime auto borrowers.
Yes, I saw this. A lot of people were going crazy about that one.
And then buried in the 9th paragraph is like, but it's still below 2019 levels or something like that. It's like, well, you should lead with that. Like, so anyway, the other part of it is,
outrage is a business these days.
Yeah. So anyway, and then there's definitely, listen, there is the inflation component, like the pandemic component, breaking a lot of people's behavior. So when I was it's funny because I actually
I think the pandemic actually made it more mainstream just to complain about everything. I think complaining now is like,
and just distrust is at an all-time high in all of our institutions.
It's a way that people like come together is like through complaints.
Totally. So I actually had this in the doc last week. I just forgot to get to this. I saw a video, I don't know if it's San Francisco, wherever it was, about a fight in the NFL stands. And I was thinking like, what the hell happened to NFL games where it just became a thing? Like, do people go there with the intention of like, I'm gonna get into it with somebody, with a stranger today. I'm gonna get into it with the opposing team. So it's just bizarre. I was in. So
I've never understood the fighting thing.
It's
like
just bizarre.
The amount of stuff that can go bad versus the amount of stuff that can go good. Look, I don't see the upside in fighting.
I was in the second row behind the end zone. It's my friend's tickets that his dad's had for like 50 years or something. And side note, live events are great, but it is impossible, very difficult, at least from the seats that I was in, to follow the flow of the game. It's like Saquon got hurt. I wasn't really sure what was happening. You can't really tell where the lines are. It's such a better experience at home watching football.
Isn't it though?
It's so much better to follow the game. So anyway, there was people in my stands that were getting into it, almost close to throwing fisticuffs. And I was just thinking about this on the walk out. Like, what happened? When did this happen? Is this I know there's always fights, but is this a post-pandemic thing where it's ubiquitous?
There's just a lot more anger. Yeah, I don't know.
And but I think but that's the same with like flights on the airplane. It's just something is wrong. Something is very, very wrong. even though things are like objectively pretty decent, at least just quantitatively. But you can't discount how people feel. You could like point, you could get to the root of it, but people feel how they feel. People are pissed off.
Yes. And it does get down to something of like, I'm fine, but everyone else is in a shitty position. I think that's part of it too. So I sent this to you. The story last week came out. The Federal Reserve does a survey of consumer finances, and they do this every 3 years, and they look at the well-being of households on a number of different perspectives. So I dove into this big time, and there was a 37% jump from 2019 to 2022, and these are inflation-adjusted median numbers.
Say that one more time.
So inflation adjusted and median numbers. So I did median, not average. Median means middle. If you've never taken a stat class, median is the middle number.
And net worth. And net worth is not income.
So if me, you, and Bill Gates are in a room, the average net worth is billions of dollars. The median net worth is not. Right? So we got that out of the way. So I did a post about this. And again, 37%, I looked at it. So I dug through all these numbers.
A 37%
that's the kind of thing I do. So a 37% change in 3 years in net worth, which is crazy. We talked about 2020. This is through 2022, which was the worst year ever, one of the worst years ever for a stock and bond portfolio. And net worth was still up 37%. And so I looked at it, and it was by far the greatest 3-year change in net worth. And they've done this going back to 1989. The previous one was through 2007, it was an 18% change. And actually through 2019, it was 18% as well. And I put this out on Twitter. I wrote a blog post about it, and I told you, look through the replies.
Yeah, they're
because sometimes I think you don't believe me about the doomers. And these people were out like savages coming to get me saying, well, it's only the top 1%. And I said, no, these are median numbers. And then they said, well, it's all inflation. And I said, no, these are inflation. So usually I usually just block those people because I don't want them in my life. But this time I actually engaged, and I just said the answer. This is median. This is inflation adjusted. People don't want to believe that this was an unequivocally great report. And people said, well, it's all housing prices. And I thought it was too, until you realize renters experienced a bigger gain in net worth than homeowners. Renters saw their net worth increase by 43% versus homeowners were 34%, which there's still a way bigger net worth for homeowners, but still, that was surprising as well. Household debt grew less than 4%, while net worth grew 37%. Like, these numbers to me is like unbelievably good considering what we've been through. Really high inflation, the pandemic, and you can put all the caveats you want on it. I just think it's okay to say, like, gosh, considering everything we went through, the fact that we saw one of the biggest increases in net worth for households ever is kind of something to celebrate. And like, that's amazing.
I agree. I think one of the reasons why people attacked you is because they're putting thoughts in your mouth. Like, oh, so everything's fine, Ben?
Yeah, that's the thing. People want to read into what you're saying instead of just saying, these are the facts.
Right.
Like, these are the actual facts.
Well, here's another fact. I don't think people's happiness is really correlated kind of at all to net worth. Now, I do believe...
And that was the best rebuttal that people said is like, well, money's not everything. And
No. Money is important. I think people are concerned about their real income. Absolutely. But I think your net worth doesn't really impact how you think about your financial situation.
Yeah.
It's not like, it
should.
Well, I guess. But if somebody's like, well, I've got $70,000 in this IRA. It was only 47 last year. It's like, yeah, but like things are still kind of shitty.
Yeah.
You know, and like, I have more money because my student loans were on hold, but they're coming back and like things are still kind of not great. Now, I'm definitely not saying everything's not great. And I know you're not saying everything's not great either. I'm sorry. I was saying I don't think everything's bad. I don't think everything's good. I think the volatility of prices and perceived economic stability is just not great.
Maybe that's what we've learned. Yeah. Economic volatility, people do not like that at all.
No.
But again, no one was really happy in the 2010s either. I'm not saying like, listen, idiots, you should all be happy. It's just like, I'm saying there's more nuance than everything is awful right now.
I also think, and I know we are repeating ourselves because we talk about this all the time. I think asking people how they feel like just yield some really wild results. I think people can live their life, go about their business, and be as unhappy or as happy as people were in the 70s or the 50s, generally speaking. People are people, and the environment around us is always changing. But I think surveys are just skewed to show you that everything's really bad. I agree with that. And right? I don't think it's like when you go out to, I don't know, the pumpkin patch or whatever, like is everybody like walking around like all grumpy and shit? And like, no.
True. And I don't think these surveys are ever going to get better. Now that the internet's with us, I think there's going to be a line of demarcation in the future where they go, why did everyone say they were so unhappy after the 1990s? And it's like, oh, okay, the internet, social media.
And
I think it's going to be a
it's
thing.
online people. If you ask your friends that don't spend time on social media, like, how do you think things are going? They'd be like, do you think it would be like unanimously, not unanimously, majority would be like kind of shitty actually.
Yeah, most of them will be like, I'm fine. Yeah,
Fine.
depending on their situation, obviously.
Nick also did a post on this. He showed the real median net worth by year. And yeah, again, it's at an all-time high. Real median net worth by year for households under 35 rocket up to all-time highs. But I don't think real net worth really matters to how people feel.
That's another surprising one, though, that I think the increase for under 35 was like 140 something percent on a real basis. Again, inflation adjusted,
amazing
median numbers. But the people were saying to me like, oh, great, it's coming off of a low base. So it's like, you can't win. But I think that's amazing. Young people saw a huge, and these are young people who, for the most part, probably many of them didn't own houses and didn't get that tailwind.
So, yeah, and I also think that people are just bracing for impact, right?
Yes.
A lot of people might feel like a recession is coming.
Yeah,
so for example,
been in this position for like 18 months, like just waiting.
So Matthew Miskin tweeted, make that 15 months of negative year-over-year readings for the Conference Board leading economic indicators. The longest stretch of year-over-year negative readings before a recession was 17 months from August of 6 to January 2008. So we're getting there. And then
the pandemic broke economic data. I'm still sticking to that.
It did. Here's an email that we got. Peace delegates here attacked by U.S. activists on Russian policies. Electricity bills due to rise. The White House urges delay on Russian trade. Food ferry to Egyptians. Oil curb spread worries Europe. Israelis see ceasefire only after Palestinian defeat. Jets flown by North Koreans are reported in clash with Israelis over Mideast. Bank funds insolvent. Saudis cut oil output to 10%. Value of dollar change. Arms aids to Israel may cost $14 billion. 50 million bushels of oats listed as disaster reserve. You get the point. I'm almost done.
Yeah.
But I'm like, enough. Like, is this really all happening? Like, it's too much. And then the kicker is, this is a New York Times headline from the week of October 1973. Oh,
I love these kind of things. That's great. Whoever
it hurt to read this. I was like, dude, it's enough. Like, stop. I don't think his point was like everything's fine or ignore all the horrible things that are going around in the world. This is the world.
Yes, unfortunately, this is the world. Here's some good news about higher rates though. So I looked at this. The last week I looked at this and it was 8% mortgage rates and 4.9% treasury yields. Here's my.
Are you about to spend 8% mortgage rates into a positive? You might want to take a beat.
Here's my Ben positive spin for the next downturn. That I feel like a lot of people are people always say the Fed is pushing on a string. Monetary policy is going to be very effective for the next downturn.
Monetary policy?
So for a while there,
Why though?
Because rates were at a zero bound, monetary policy was not doing much at all. And now that rates are higher, when the Fed lowers rates, if mortgage rates go from 8 to 5,
true,
and there's going to be a huge amount of activity in the housing market. Like if that's what I'm saying. If the Fed does raise rates, if we get a downturn and they go from 5% to 3 or whatever, and mortgage rates go from 8 to 5, I think that monetary policy is going to be very effective.
Well, there's two economies. There's those that are affected by interest rates and those that aren't. And the average effective debt for the S&P 500 is under 4%, which is kind of wild. We've spoken about this a lot, right? About how much of the debt is long-term fixed. But there's from Torsten Slack, there are 33 million small businesses. You know how much it costs them to borrow money? 10%.
Maybe the next recession is when you go hand over fist into small caps, because the large caps have benefited because they locked in low rates and they did fine throughout this whole period of rising rates. And the next period is going to be better for consumers and small caps. How's that?
Should there be higher penalties for people that get into fights at football games? Like, what do we do about this?
Ban them for life?
Sure, absolutely.
Yeah. This kind of affected you, didn't it? I do agree. I took my daughter to a Michigan game like a month ago, her first time ever at the Big House, and just swarms and there's 110,000 people or whatever. And it certainly was on my mind, like, is my daughter going to see some crazy stuff here? And luckily nothing happened and it was a good game and it was fun. But I did think about that. Why is it football
games? Like, it's not like, and by the way, they cut off beer at halftime. So I'm going to the Knicks game on Wednesday. I'm sure I won't see a fight there. I've never seen a fight at the Garden.
That's actually kind of surprising.
Is it because
people, just more testosterone? I don't know.
Well, people tailgating.
Yeah.
So more drunk people.
True. All right, so I mentioned the monetary policy thing. I'll skip this inflation. Skanda Amarnath wrote, as heretical as it might be to say, there's a growing risk that the Fed rate hikes risk stoking higher rent inflation in 2025, 2026, and 2027. How? The Fed's actions are currently reducing building permits for multifamily rental supply, exacerbates structural housing shortage. So we had the biggest build ever, I think, for apartments, multifamily, that sort of stuff, and to meet demand. And that's one of the reasons rents have been falling lately. And now with, 10% construction loans or whatever, 12% construction loans, those are falling precipitously. So there's going to be some unintended consequences of this period where I think the housing market's going to be even more broken in the future than it is now, potentially. I'm just preparing people for that.
Great.
Oh, wait, do I see another DoorDash in here?
I said I wasn't going to do it.
Oh, boy. All right. Hit me with it.
All right. Here's
Wait,
Indian.
Whoever sent us the Grubhub thing from Amazon Prime, I've been using that. Why aren't you using it anymore? Use the Grubhub. It's the Grubhub Prime. I signed up for it.
Okay.
You gave us the link.
All right.
What are you doing?
So Robin was out.
This is your own fault.
I wanted to get Indian food. Here's what I was getting. One of the chicken dishes. It could have been chicken butter or butter chicken, or it could have been chicken tikka masala. I don't even know what chicken it was, but it was chicken that I wanted. And I also got naan. So it was $30, which is like, I don't know, I guess that's what food costs now. Seems kind of expensive to me, but fine, it's good food. The delivery fee, $4.50. And I thought that I had free DoorDash because my Chase card, but whatever. Delivery fee, $4.50. Fees and estimated taxes, $7. Tip, $5.50. Total, $47. Yeah, f***ing right. $47 for takeout Indian food?
Your fault. Why aren't you using the Grubhub Plus that someone gave us? I'm saving money on that every time I do it.
Now, mind you, I did not order this. There's no way in the
you
world.
stopped yourself?
Absolutely not. $47 for takeout Indian food?
That is pretty nuts. For one person.
For one person.
That's crazy. All right. Someone sent me this piece from Slate. John Hussman, I would be remiss not to tell you that the stock market will probably crash. Henry Blodgett wrote this piece. John Hussman thinks there's a good chance the stock market will crash soon, 40 to 50%. And even if the market doesn't crash, Hussman thinks stocks are priced to produce returns of only a couple percentage points per year over the next decade, far below the 7% inflation-adjusted long-term returns that everyone is used to and the double-digit returns of the last few years. This is the coup de grace from Blodgett. If you want to feel comfortable and happy, go ahead and ridicule John Hussman with everyone else. If you want to prepare yourself for what seems like a possible stock market future, however, read on.
That's him. That's him writing.
Henry Blodgett writing.
Henry Blodgett. Oh, really, Henry Blodgett? Give me a break. I was in the airport on my honeymoon in 2013 reading this nonsense.
Yes, I didn't. This is the punchline that.
Remember when Henry Blodgett stopped reinvesting his dividends? Ooh, what a courageous call.
No, but that's the thing. For the listener, this was written in 2013.
I'm taking the bait. I'm taking the bait. Shame on me.
The S&P 500 is up almost 12% per year since this was written. I just want to point this kind of stuff out. When
wait a minute. This
crash.
post is from 2018, 2013.
Yes. So it's been 10 years. So he said in 10 years you're going to see a couple percentage points. This was written in 2013. Someone sent this to me.
I thought it was a reflection. Okay.
As like a reflection, like, hey, it's been 10 years since he wrote this.
Got it.
And so he was saying the Dow was going to crash from 15,000 to 7,500. The Dow is now at what, 30,000 something? So like you'd have to crash 50% from here and then 50% from there just to get to the original crash call.
What do you say to somebody that listened to you 10 years ago about this crash call? I'm sorry. Well, I hope you didn't listen to me.
I think there's confirmation bias and people just continue to want to hear it. I don't know. But I just want to point that out when you hear someone say this, this is the kind of stuff people are always saying. The 2008 crash is going to look like child's play compared to the next one. Right? This is the stuff why we're
bad things happen.
Yes,
bad things happen in the world and in the stock market, and that's why risk assets pay you to bear that risk. It's very simple.
Yes, but
you're paid to
and the times the bad stuff does happen, the people shouting about it are not going to be the ones who help you out. All right.
Okay. Ben, are you a buyer of target date ETFs?
529 plans for my kids. I'm in target date funds, yes.
There's a target date ETF. So BlackRock is launching them. It says that they did, because I was thinking, I feel like they had these already. They did. In 2014, they launched them. And they
you mentioned that before, and I thought, like, why is he talking about this? I didn't think about it, but there are no target date fund ETFs, are there?
Well, so BlackRock launched one in 2014, never took, but they just launched one again. I don't see target date ETFs gaining popularity.
I don't either, because it's mostly a 401k, 403b kind of thing. That's where they make sense. And that's where they probably belong.
I'm not saying they can't make sense in an ETF. I just think people are prone to invest that way in a retirement account, not a brokerage account. All right, this is interesting. Biggest outflow from money market funds on record last week.
I bet it's all going into bonds.
Yeah, I wonder if this is like skewed by like a gigantic sovereign wealth fund or.
No, but don't you think it makes sense now if bond yields are matching money market yields, that you can lock it in for longer, that money would go out of money markets, and that's cash on the sidelines for bonds. I think that makes sense.
Oh yeah. I think that absolutely.
Here's another one. More likely, 4% rates, 6% rates.
On what? The Fed funds?
10-year. You've been talking about how we missed the bond yield rise and saying, like, once they hit 3%, people are going to buy. Doesn't 5% kind of feel like a line in the sand?
I can't say that.
I would say 4 over 6, but I've been wrong about this for who knows how long.
I would say 4 over 6 too. I don't shudder to think about either situation. Right? Like, what would have to happen for either of those things to transpire? That's a good question.
Here's a question. Really strong to get to 6.
Would you rather see rates at 4 or 6?
I think 4 would make people a lot happier if it happened because of falling inflation. I think that's the better scenario.
Well, but what if it happens because the economy is slowing? Would you rather 4%? Would you rather 4% because the economy is slowing and we're in a recession, or 6% because the economy just won't stop growing?
6. Give me 6 every day. If the economy is strong enough to push us up to 6% rates, and people are making more money, sign me up for that.
I think so too. I think so too, but I don't know.
So last week I talked about the efficient market hypothesis of Bitcoin. Like, why doesn't it just stay at 30 or whatever? Because we know the ETF's coming. So maybe Bitcoin did continue to price in ETF. So in the last month, Bitcoin has gone from 26 to 35. I think it hit 35 overnight.
Yeah.
I don't know what's that right now. It's up 110% this year. Just a wild, crazy.
Just saying, one of my predictions for 2023 was Bitcoin going up 100%. Seemed pretty ridiculous at the time.
Did you really?
Yeah.
That was one of your like 10 surprise predictions.
What are you quoting? Let me allow myself to quote myself. What did I say? Now, I'm sure I got a ton wrong in here, obviously, but all right. Crypto doubles in 2023. It's hard to make the bull case for an asset class that feels like it comes with career risk. With all the negativity surrounding the space right now, I'm amazed that Bitcoin isn't below 10,000. And maybe that's what the bulls can hang their hat on. Bulls will say that we've been here before. Look at the drawdown chart. Yeah, prices have seen these types of decline before. But in every other decline, crypto is just a fringe asset. I'm not going to read the whole thing, but.
Okay. All right. That was a good prediction. Read us one of your terrible predictions.
Okay. Let's see. The market avoids a recession and stocks gain double digits.
Pretty good.
Looking pretty good. What was bad? The housing market doesn't crash. Check. Gold makes a new all-time high. Getting close there. All right. IPO market remains frozen. That was pretty easy to say. Here's my bad call. Okay. Value outperforms growth again. There we go.
Okay. Yep.
That's a horrible, not even close. It's another one that I'm glad didn't pan out. Tech continues its layoffs. Not really true.
Oh, that is true.
That's actually such a great reminder of what we spoke about earlier in the show. When layoffs were happening, that's all that was being reported on. Right? I understand, rightfully so. You're going to report on Salesforce and Meta layoffs, of course. Why wouldn't you? Right. But there's no reports when there's no layoffs.
Yeah, so there's no headline saying no one got laid off today.
There's no headline like, remember all those layoffs? Well, that stopped. That's probably a good thing, right?
Google just hired another 3,000 people this week. No one talks about that.
I didn't hear about it.
I made that up.
Oh, great chart from Goldman showing the distribution of rates on outstanding mortgages. And there's so many mortgages Actually, the highest bar is like under 3%. Looks like almost 15% of mortgages are at like the 2 and 7/8 level. Would you say is that about what I'm looking at?
I'm sure there's a future value you could do with interest rates and stuff, but like, how much would you say your 3% mortgage rate is worth to you as a financial asset?
Everything.
It's worth so much money, right? If you tried to like do the math behind how much is worth to you versus having a 8% mortgage right now,
If I was in the market for a house right now, I'd be very, very upset.
stressed out.
Stressed out is the right word. All right, so mortgage purchase applications index is at the lowest level since 1995. Housing market is effectively frozen. The home builders were able to like subsidize a lot of these, give buyers a lot of points, but with rates at 8%, I don't think they can do it anymore. Chen Zhao is the economics research lead at Redfin. Estimated that total existing home sales in 2023 would be 4.1 million, which would mark the smallest number of sales since about 2008.
It is crazy that we're back to like housing crash levels.
Look at this
Without
chart
a housing crash.
Look at this chart from the Wall Street Journal showing the amount of homes that are sold and the median price. Now, the median price is still basically near all-time highs.
This is like one of those things pre-pandemic. You tell someone the number of sales are back to 2008 levels. Housing prices are at all-time highs. What made that happen? I don't think you could come up with an explanation. Like what would cause this to happen?
Right. It's funny because
knowing what happened.
You're so right. There's no way that you could be like interest rates skyrocketed and made people trapped in their homes. You would never come up with that conclusion. But when you lay it out like that,
it makes sense.
It makes total sense. People can't afford to move. There's no supply. There's still buyers. Prices are still high.
So on the odd lots, they had the guy from Morgan Stanley. That's it, Jim Egan, something Egan. And he talked about this last time, but it's worth repeating. He said for years, 25% of homes in the U.S. are owned by people over 65. Now it's up to 33%. And a lot of those owners own their house free and clear with no mortgage, no
where are they
impulse
going?
to sell. So even if we see a recession and a rise in layoffs, there's a large swath of the housing stock that won't be affected by macroeconomic conditions. The boomers are like, in a lot of ways, they're insulated from a lot of the economy. That's why they're spending and why they're not impacting the housing market, right? They're like, boomers are in a pretty darn good position. They can earn interest and yield on their savings now.
Here's a good one.
Good place.
There was a ton of hullabaloo about the median, about what somebody must earn to buy a house.
Yes.
The number was, it says, Bloomberg reported buyers must earn a whopping, they use the term whopping, that's their words, not mine, a whopping $114,000 a year to afford a typical U.S. home. Well, Matt Klein, average household of income of an American in the 35 to 44 age bracket was $170K last year.
Which is shocking to me. And I looked at the comments, someone said, okay, what's median? Because that's what you do on Twitter.
What's median?
And he said median's 100. So it's pretty close. So he's saying the group that is in their home buying years, 35 to 44, is pretty close to what you need to buy a typical U.S. home.
Yeah.
It's not like you can't compare it to the total. That's pretty good. All right. The Wall Street Journal had another one on rent versus buy, saying there's never been a better time to rent and a worse time to buy. It's the premium discount of buying a home versus renting it. It goes back to 1996 from CBRE. And here's my question. What causes this to mean revert? Because a lot of people say, the housing prices have to crash. Like a lot of the landlords have locked in 3% mortgages too. So they can actually afford to charge cheaper rent. Like rents don't have to, and the reason, again, I said rents are rising because they're building more apartments and more multifamily housing as opposed to single family housing. But I don't see what causes this to change. If you're a landlord sitting on a 3% mortgage too, your costs are covered. You don't have to keep jacking up rents, even though you probably can a little.
That's a good point.
So what causes this to mean revert? There's not like a catalyst that's going to make this happen.
And should you might have said this, shouldn't there be a premium for buying a house?
I think there should be a little, there shouldn't be this big of a premium,
right.
But I think the fact that there was a discount after 2008 when the housing prices crashed, I think that was an aberration too. All
right, here's a quote from an attorney at the DOJ. There's no reason that home sellers should be forced to pay a buyer's agent. Here.
That is one of those things that's like, why do we do that? Because we've always done it like that.
Yeah, because that's how it works.
But don't you think that if, I know a lot of people say like the 6% realtor commission is criminal and we should take it out. Like, don't you think that housing prices have kind of adjusted for that commission though? Like if it completely went away and everyone could just buy, like, for sale by owner, wouldn't housing prices adjust to account for that? Or do you think that the market is not that efficient?
I don't know. I don't know.
Okay.
That's a good question. All right, there's a interesting chart from Carta. Highest number of shutdowns in the third quarter of 2023 for startups. This does not look like it's done.
That makes sense. We talked to Samir last week about the state of the venture capital industry and talked about how it is interesting though how like vibes and not like I don't want to say speculation, but interest rates don't matter as much to venture capital because they're not borrowing a ton of money, right? So it's more investor appetite for risk than it is anything, right? Like the private equity should be more impacted,
which is
tied
to the cost of capital. But you're right.
Yes, but venture doesn't have that. But it also makes sense that people's appetite for risk changes when rates change. But I guess this is not surprising considering the number of companies that were funded.
Okay.
In the past.
All right, let's do a segment on some of the earnings reports that we got this week. All right, here's a plug for Quarter. They, as I mentioned earlier in the show, the desktop page has gotten so good. It kind of looks like an iPhone app.
The funny thing is when we first saw Quarter and they gave us a demo, must have been, I don't know, 2.5 years ago, they didn't even have a desktop app.
No,
right? It was just an app, and they all the things that they've added. It is pretty
well. When they started, there was no transcript. There's nothing, right? It was just the call. So that now, they have live calls now, but also they have live transcripts. So it transcribes AI. I don't know how they do it, and they're looking to expand into the United States. They're looking for a salesperson, so they're crushing it in the Nordics. With analysts and sell side shops. And so if you're that person in the United States and you're like, I have a network and you want to reach out to them, just go to quarter.com and hit get in touch. Okay. Netflix. I don't think I spoke about this. I did buy back Netflix.
Wait, I didn't realize you ever sold it.
I did sell it. I sold it. I bought it back early in October. I thought there was going to be support at like the 200-day moving average. I just wanted to buy it. There wasn't. It broke pretty aggressively. But
I have a Netflix ticket. I'm saving for my recommendations.
Okay. But then they had a great earnings call. We now expect free cash flow of $6.5 billion for 23, up from our prior forecast of at least $5 billion. They repurchased $2.5 billion worth of shares in Q3. They increased their buyback to $10 billion.
That's interesting that no one ever talks about like Netflix becoming a company that's buying back shares.
Yeah. Adoption of our ad plans continue to grow with the ads plan membership up almost 70% quarter over quarter. So the password sharing crackdown is working. 30% of signups in our ads countries are on average to our ads plans. They added, I think 11, what did it grow? 11%? Yeah, they grew their subscribers 11%. Alex Morris has this great chart showing the number of subscribers, which did flatline, right? Like it totally flatlined. Hence, we have to do something. Okay, time to turn the lever on or pull the lever on the sharing crackdown. You know what's kind of nuts? Just like what Netflix is able to do with its content distribution. I never watched Suits. I know it was a popular show at the time, but they bought it from, I don't know who owns Suits.
USA. It's like USA Network.
So who owns that? Is that Paramount?
Probably.
And now they're buying shows from HBO, but Suits was the number one show in the world. Yeah. A show that's probably been off the air for 10 years.
They're tastemakers.
For sure. So UCAN, which is United States and Canada, added 1.75 million net paid subs, its highest sequential gain in 18 quarters. Over the past 6 months, UCAN added 2.9 million paid subs.
Wait, what's UCAN?
United States and Canada.
Oh.
So they added 2.9 million paid subs over the last 6 months, which compares with 4.4 million over the previous 3 years.
So the crackdown on passwords worked.
Oh yeah, it's working. And advertising their partnership with Microsoft seems to be going well.
That's the thing. Once I know people jump in and jump out of these things. For me, once I sign up for a streaming service, I'm basically in it for life.
Yeah.
It's gonna be hard to get me out of there.
So it is interesting when you compare them versus Paramount still looks like horrendous. It's basically at a 52-week low. Disney popped on some of the news to divest its India operations, but Disney's not looking exactly great still on that as well. Warner Brothers Discovery. I mean, there's got to be consolidation in 2024. There has to be. Well, it doesn't have to be, but given debt loads,
There should be.
There should be.
It's just, will the egos allow it to happen?
All right, so I listened to Tesla's call.
Does Musk do these calls or not?
Oh yeah.
Okay.
Yeah. But it's interesting. Like their operating margins are going down so bad. It was 18% in 2022, and it looks like it's gone down for.
Wasn't that because they've cut prices so quickly? They've really cut prices at Tesla.
So they asked the CFO like about it, and he gave sort of a garbage answer. But if you listen to the conference call, the actual results were not great. But if you listen to it, there was not really downbeat at all. It's not like the questions from the analysts were exactly pressing. And I think that's probably mostly the case, unless the company's just like a whatever company that nobody really cares about. Like nobody wants to step to Elon. Like nobody really held his feet to the fire at all.
Yeah, but don't you think that's the way it is with most analysts?
Yeah,
do they really hold
especially with Elon, they're not going to. And I was just thinking about the volatility of Tesla stock. So it was down. It fell 17% in 3 sessions, and look how many times it's done that over the last 5 years. That's like nothing. Like,
yeah,
it is just a wildly volatile stock. So here's a couple of quotes that I pulled from Elon. Also, in the quarter app, you could highlight right in the app, and then like go like it keeps like a notes section for you. It's just incredible. We will continue to invest significantly in AI development, as this is really the massive game changer. And I mean, success in this regard in the long term, I think, has a potential to make Tesla the most valuable company in the world by far. So he said stuff like that before, but I didn't know that that AI was going to make Tesla the most valuable company in the world. He did mention something about interest rates and how it was impacting the consumer. He said, talking about the Cybertruck, I think this is potentially our best product ever. And I think it is our best product ever. It is going to require immense work to reach volume production and be cash flow positive at a price that people can afford. Often, people do not understand what is truly hard. That's why I say prototypes are easy. Production is hard. I got to give him credit. He is good on these calls. People think it's the idea, or you make a prototype, you design a car, and as soon as you design a car, it's not just anyone can do it. It requires taste. It requires effort to design a prototype, but the difficulty of going from prototype to volume production is like 10,000% harder to get to than to make the prototype in the first place. And then it's even harder to reach positive cash flow. That's why there have not been new car startups that have been successful for over 100 years apart from Tesla. So I just want to temper expectations on Cybertruck. It's a great product, but financially it will take, I don't know, a year to 18 months before it is a significant positive cash flow contributor. Guess what? There's no way. It's just based on the way that he's saying this. It's not going to be a year to 18 months. I would definitely take the over on that.
So here's the Cybertruck cycle. The tech bros will buy it for sure. All the Elon stands. But then some people will, because it's a weird looking car.
I think
whether you like it or not.
I think it's heinous.
Yeah, I think it is too. But I think some people are going to buy it ironically at first, and then unironically. That's how things work now. You like something ironically to show like, I'm kind of hip, and then somehow at some point it gets murky and you just like it unironically. That's what's going to happen with the Cybertruck.
I was looking at Ally, and Ally is a great look through to the consumer. They've got they're the gigantic digital bank, but they've got a huge auto department. So auto delinquencies are going up, as we mentioned earlier in the show about the subprime number. So 1.03% are, I think it says 65 days in delinquency. But if you look at the year-over-year change in 30-day delinquency, it's well off the highs. So that peaked in Q4. It was 1.4% in Q4. Now it's down to 0.93%.
This is where it makes sense for higher rates to have an impact, is the auto market, right? Way more than the housing market, that the higher rates can impact autos really quickly.
Big time. So last week we mentioned the Apple Buffett thing about like, would you rather $10,000 or never have an Apple product again? And somebody emailed us. He's like, actually, I was the one that got that thing going, and it was on CNBC. They said, here's what the actual quote was. If someone offered you $10,000 to never buy an iPhone or Apple product ever again, you wouldn't take it. If someone offered you $10,000 to never buy a Ford again, you'd take it and go buy a Chevy. Do you remember Cameo?
Yeah, it's a thing where you pay someone to like say happy birthday to your friends or whatever.
So there was an article about Cameo in the New York Times. The CEO, Mr. Galanis, he met with Masayoshi's son on Zoom in February 2021. And Masayoshi offered him $400 million in cash, 4 times the company's fundraising goal, and told him to spend $100 million of it at the Tokyo Olympics. He didn't take the $400 million. But
so I assume that company's crashed. It had to, right?
So it's nearly 400 employees have shrunk to 33. Magic Johnson, who was paid for his role, left Cameo's board after not fulfilling his obligations. Still, Mr. Galanis argued that Cameo was thriving and absolutely still on track to become the next Disney.
Sure.
Revenue has not grown year over year since January to June 2021.
I mean, it's the kind of thing that maybe you'd like do it once as a joke, like, hey, this person from a 90s sitcom, here's their cameo video. Like, it's not a business that's you use over and over again.
Ben, I tried to send somebody who I don't follow or who doesn't follow me. I tried to send somebody who doesn't follow me a DM last night. I can't do it. It said, get verified to message this user. Only verified users can send direct message requests to people that don't follow them.
Oh, okay. I paid the $8. I thought like I was going to get fewer ads, but no. And also I appreciate, this is going to sound like a humble brag. I get 10 messages a week in DMs from people saying, hey, there's a bot of you. I reported it to Twitter. And I say like, thanks, I appreciate it. But there's like 10 Ben Carlson bots. I can't even imagine someone who's actually famous, how many they get. I get fake accounts for me all the time.
What do you get?
I don't think they care about it.
What do you get for paying? I mean, I think you probably get boosted. Like I've seen a lot of people saying like, I have no engagement anymore, like whatsoever.
I honestly have not. If there's a difference, in paying versus not paying, I haven't noticed it.
Yeah.
So, whatever. I'm doing my part, I guess.
All right. So we spoke about the survey last week about airplanes. Here's an email that came in. I find airplane seats to be very uncomfortable when in their full upright position and far more comfortable when reclined even just a little. I'm a golden rule type of guy, so the way I would like to be treated is to not have people get mad at me when I recline, and as a result, I don't begrudge a person in front of me for reclining. That's an interesting spin. I never thought about it that way. Right? Because my golden rule is like, well, I wouldn't want it done to me, so that's why I don't do it to the person behind me. This person's like, well, I wouldn't mind if the person did it to me so long as I could do the person behind me. I get it. All right. Another survey. Zillow survey finds 35% of prospective buyers would buy a haunted house if it costs less.
Of course you would, because haunted houses are not real. Okay.
I'm all in on haunted house movies. We'll come back to that in the recommendations.
Okay. But the people who say like there's a spirit living in my attic and it's like I heard something. Yeah, if you're gonna discount that house for me, sure, I'll take it.
After seeing this haunted house, I will never live in a haunted house ever.
In my parents' neighborhood, there was like a murder down the street and like trying to sell that house and went fine. Like that's like if someone is really murdered in a house and like there's a murder crew to come clean up, I think that should be a discount.
Yeah, that's
not tough. A haunted house. Wall Street Journal, too expensive to have fun. They looked at nearly 60% of Americans say they cut back on spending on live entertainment because of rising costs. The average cost of a ticket went from a little less than $100 pre-pandemic to $120 now, after dropping to $60 in the pandemic, of course. 37% of respondents say they can't keep up with the rising price of events they want to attend. 20% say they're willing to take on debt to continue to be able to afford their favorite entertainment activities.
See, Ben, this chart looks exactly like real net worth, but it's not real net worth. It's what shit costs, and therein lies the difference.
True. But I think it makes sense, though, that costs for live events should be going up. I actually think this makes a lot of sense because everything is so online and screens these days that people are willing to pay up for an experience, and I think it makes sense, and these prices should be higher. How's that?
Okay. Well, how about this? We went to Billy Joel on Friday night, which, by the way, made me feel quite old because when he played River of Dreams, I was like, oh, his new song. Because I remember when that song came out. I think that song came out in like 1994. Let's say
Billy Joel is he's like the king of Long Island.
He is.
Like I feel like if you live in Long Island, like you have to go see Billy Joel like 6 times a year.
So there's so many songs that are it's just like the Pledge of Allegiance for Long Island. So anyway, yeah, his new song came out in 1993, and it did make me feel old. But anyway, at the concert, Robin got a Casamigos silver, just regular with club soda. She got a double. $47. And that was my reaction. I just started laughing. Like, okay, that's just what we're doing now. Like,
Yeah.
this is where it is. It's $47 for 2 ounces of tequila.
It is true. Live entertainment, movie theaters, and airports, like all sense of pricing decorum goes out the window.
All right, let's blow through some of these random stuff. Somebody says it's a great Winnie the Pooh thing. Equity bucket on top, equity sleeve.
It's a good one. I'm
On the
a big
bottom?
Winnie the Pooh fan. Yep.
Ben, you have a new dog.
No, I don't yet.
You didn't get a new dog.
We're trying. We had
that's right.
A little bit of a mishap, but yes, we're working on it.
Let me ask you this. I know we're not doctors. How do dogs sleep under blankets? Not every day, but a lot of mornings, my dog will come put her nose under the blanket and I lift it up and she'll like just plop her entire body. How do they breathe under their blanket? I can't.
Our dog used to be under the blanket too. I don't know. That's a good question. Dogs have good lungs? There's still some air under there.
Not much.
Okay.
I set up a call with us for somebody to come on and explain to us some of the bond math that's going on. And he said, we'd be happy to do it as long as I don't end up getting shamed on next week's Animal Spirits for violating your scheduling procedures.
See, you've laid it out there. Everyone's walking on eggshells around you.
Don't mess
emailing.
with me. Listen, I'm sorry. Don't say that you can meet in 50 days. Just say no or blow me off.
Yeah, people are going to be scared to email you now.
Do you have heat on in your house?
Yes, in the last couple weeks.
Okay, where do you draw the line? Because the other day it was like, I know people are like pretty insistent about holding out. Like, I can't do it yet. When my house gets to 65, that's it. That's my line in the sand.
That's pretty cold. No, my wife is a total wimp with temperature, so she jacks it up right away.
Okay, same. Oh, there you go.
My first apartment by myself, I would keep it at like 61. I didn't care. When I was like young and broke, I and not have to pay utilities.
But your nose gets cold. Doesn't your nose get cold? Your fingers stop working?
Yeah. I grew up in a household where my dad was awful with the thermostat, and like I got used to it, I feel like.
Okay.
And yes.
So Ben, the Taylor Swift movie, did you see it? You did, right?
I saw it. My daughter's gone to see it twice. She went once with us, once with friends. My son couldn't make it because he was at a birthday party. He made my wife take him to go see it because he was jealous. So we've gone multiple times in my family now.
Well, you're not alone.
They love it.
It's done $130 million so far at the box office globally. Oh no, domestic. That's domestic. Wow. So this weekend it outpaced Killers of the Flower Moon, which I might see tonight, but oh my God, it's 3.5 hours.
That's really long. See, I would rather just them break that up into a mini series and put it on Netflix or Apple. Make it like a 4-part mini series. Honestly, I'm having a hard time getting through the book. I'm not gonna lie.
Oh, I love the book.
It's kind of a slog for me. Okay. It's interesting, but it's not as I thought it was gonna be like a page turner. It's not.
Nah, okay. I don't remember.
It's pretty slow.
So this is interesting. 46% of opening night moviegoers for Killers of the Flower Moon were under 35. What do you make of that?
Old people don't go to the movies anymore?
Is that true?
I don't know. Isn't it mostly young people go to the movies as it is? Isn't that the case?
Matthew Ball tweeted, with 71 days left, the 2023 domestic box office has already passed 2022. Are we back?
I don't know. From a low level, I guess. Not bad. All right. Recommendations. I'm going to start. Netflix actually had a pretty decent comedy. Old Dads with Bill Burr. I think he wrote it. And it's this is a thing where like you're a 45-year-old dad has a kid. Like that's the thing that happens a lot lately. You see like a dad that's much older having kids. That didn't happen when we were younger, I feel like. And it's just about that experience. But there's a great scene at the beginning of like having to discipline your children in front of parents and other parents, like your friends. It's so awkward because if you go too hard, everyone's like, whoa, take it easy, psycho. But if you go too easy, everyone's like, geez, you went pretty easy on that kid. Just let him off. Like you're so there's no way to win disciplining your children in front of friends or other parents.
Yeah.
But if you like Bill Burr's comedy, it feels like the movie feels like his stand-up in a way. So if you like Bill Burr, you'll like the movie. I was surprised. There was multiple parts that I laughed out loud. I rewatched the Forks episode of The Bear. I know you didn't care for The Bear. The episode where Richie works in a high-class restaurant to learn how things work in like a really upscale restaurant. and it has a Taylor Swift. I forgot there's a Taylor Swift song like lead into the show that like paid off with a Taylor Swift song. I think it's one of the best TV episodes of the past year or so. And
Wait, you rewatched a specific episode?
Yes, I don't know why. I put stuff on in the background when I'm writing or stuff at night, and it's just an amazing. I think it's one of the best episodes of TV in a while. I think the other ones were, what's the zombie show on HBO?
The
Last of Us.
Not The Last of Us.
Yeah, that episode where Ron Swanson was in the bunker one, that was good. You could probably put a few Succession ones in there, but Forks, for as far as I'm going, The Bear, one of the best episodes of TV I've seen in the past year. That's all I got.
All right, I heard from a lot of people about VHS. I watched a bunch of them. They are scary. They really are.
There's a lot of horror psychos out there. You got a lot of people who are defending your horror takes, saying Michael's been on a roll lately with horror takes.
Well, I've got more. Somebody emailed us, hey, check out Deadstream.
I can't believe you haven't run out yet. You literally watch like 3 horror movies a week.
Somebody said, check out Deadstream. And I replied without even looking, I'm in. It's the opposite of live stream, but it's the same type of thing as Chad Gets the Axe. I'm not done with it yet, but it's really scary. Quite scary. What else did I watch? I took Logan to Paw Patrol. On Saturday it was raining, so him and a few of his friends went to see Paw Patrol. Now Logan already saw it. I'm not watching Paw Patrol. So you know what I did? I downloaded a movie into my iPad.
You sent me a picture of it. You were watching a movie on your iPad?
Brought my noise canceling headphones. The movie was called, and this is not a joke, and actually, now here's the thing. When I'm talking about these movies, so I watch a lot of movies that are just like garbage, like just horrendous, not even bad good, just bad, atrocious, like wouldn't even dare have somebody think it's a recommendation. All these movies that I'm talking about right now, while they are obviously selective, right? Like if you're not into horror, which is most of the audience, you don't care about this. But if you are into horror, I'm only mentioning these movies because I think
you don't have to clarify for me.
I'm just saying. So that's a lot of throat clearing for what I'm about to say. Okay. So here's a movie that I watched at Paw Patrol, and it was a very interesting juxtaposition of a bunch of 4-year-old boys watching Paw Patrol. And you know what I was watching? Hell House LLC. Now, Hell House LLC, much like Haunt and much like Deadstream, is about, so this was inspired by like Blair Witch. It's like found footage, like what really happened. And it was very effective and frightening as all get out. And guess what? I had to take my headphones off at some points because that's how scared I was. I was watching it with the volume off. I couldn't take it. It was too much.
Okay. I can't believe you bring an iPad. They don't like look at you weird when you bring an iPad into the theater?
It was like a kid at the box office. It was like a 1:00 show.
True.
Now listen, okay. Hell House LLC, 75% from the critics, 72% from the audience.
I'm surprised they went with the LLC instead of like a solo entrepreneurship.
No, you can't put a haunted house in a C corp. Everybody knows that.
Okay. All right. Say our email address again so people don't forget it, because I already forgot it.
Oh wait, one last thing. I listened to the So I Married an Axe Murderer rewatchables.
I did too, and I rewatched it again.
Love that movie as a child.
I did too. It's on HBO right now. I watched it again after I listened to the rewatchable. The first 20 minutes of that movie, when he plays the Scottish dad, are just the Heed stuff. It kills me every time.
Yeah, Heed. Kids definitely don't know about Mike Myers.
Yes, Mike Myers. He had it going. He kind of fell off the map, but that's a great 90s movie too.
It's no Wayne's World, but. All right, out of those spirits at thecompoundnews.com. Thank you for sticking with us. If you made it this far, I know we went long. Thank you to Duncan and the whole production team. We will see you next time.